Hello, Assalamu alaikum. Okay, our lecture for today is on tax reducers or tax efficient investments. This topic is within your ATX syllabus. Now, the point is that in any developed country, right, or a country, a nation that wants to promote investment within their country, right, or they want to promote business within their country, what they do is the revenue department of the government, right, of that particular country creates certain tax laws to promote, to attract, to give incentives to investors, because obviously they're putting in the money, they're putting in the hard earned money, right? And they're taking a certain amount of risk that no one else is willing to take. So obviously they should be given some compensation for it, right? Now the point is that what type of investments attract tax incentives, or what type of investments should attract tax incentives, right? For example, there's a listed company, okay, and let's say it's a textile company that is listed on the stock exchange, and it issues new shares, for example, to raise money for a certain project, okay, for let's say for it's an expansion project, and they want to raise some money for it. You, as a small investor, as an individual, as a small investor, you putting out money, you risking your money for that entity, and then asking for a tax return, or basically treating yourself and equal to what a person, or what an investor would, let's say, invest in a, a startup, right? A small business that is what probably that just has a track record of 5 7, or probably an year, right? 5 7 months or a year, right? You cannot be equal to that investor. Why? Not in terms of your risk profile. Why? Because you have invested in a business that is, number one, easy to liquidate, right? So your investment is very easy to liquidate, right? You just have to go to the stock exchange, you have to sell your shares. Even you, the problem is, the point is that you don't even have to go over there, right? It's just at a finger click, at a click, right? It's just a click away, you can say that. How? You just place a sell order on your trading application, and there you go, you've liquidated your shares, you have the money, you got the money, right? But for someone who has, or who is basically investing in a business that has no, or very less track record, and then obviously, number one, track record is very less, or very small. The point is, they don't even have the resources to, let's say, you can say that they don't have the resources to be that big, go for a listing, for example, go to the stock exchange to get listed, or raise money from public, you can say, for example, crowdfunding. Okay, the point is that these businesses obviously struggle, and these businesses are the business which we basically categorize as SME, small and medium sized enterprises. Even medium sized enterprises are relatively larger than this, obviously there's larger than the small sized or small cap businesses. But the point is that small businesses turn out to be medium sized after a certain period of time, right? And the medium sized businesses turn out to be large businesses if, for example, the government or the country promotes it, right? So obviously, this is a whole cycle, and a large company, and this is again a benefit for the government, that a large company, the amount of tax that a large company pays, no one can pay in the country, right? So the point is, just by incentivizing, let's say, a few investors, and there will always be a scarcity of investors who will invest in small businesses. Why? Because no one has the, number one, capacity to invest in such a high risk business. Number two, no one has that amount of cash, no one has that amount of investment available, right? So obviously, just by incentivizing a few investors on their investment, you can, within a span of 10 15 years, bring in a lot of revenue. Why? Because within these 10 15 years, these companies, these small companies, will turn out to be a medium sized enterprise, or company, let's say, that you know, that let's say by chance or by having smart people around, let's say they get listed or they become huge. Not being listed or getting listed is not the only criteria of calling yourself a large company. There are a lot of large private groups as well that are working in the world. So the point is that, again, if you turn out to be a large company, you will automatically be paying a lot of revenue to the government just at the expense of some reliefs given to the investors 10 years or 20 years back. You understand the whole cycle? So this is an economic cycle basically, which I was trying to explain to you. But the point is, how is it relevant to our course? Tax reduces, again, investment is one element, right? Government at least promotes savings, right? Investment is not for everyone, all right? That is a known fact, all right? Investment is not for everyone. I have practically seen people, let's say when and this is something I do when I go around, let's say when I sit within my friend circle. There are some friends I have who earn good, right? They have good monthly income coming into the pockets. But the point is that when I ask them to set aside 10%, 20%, 15% of their monthly income for, let's say, some kind of small investment, right? Investment does not mean stock market. Investment, there are a lot of different avenues of investments, right? So let's say when I tell them to invest in the stock market, right? The point is they cringe, all right? They hesitate, they basically uh, don't want to do it. Why? Because they don't have the risk profile, right? So and this is what the government knows as well. So what the government does is, through taxation, because that is the only side they can control, right? And it's something that you are pulled towards. Why? Because it's a legal requirement, right? The government doesn't have to push you towards paying tax. You are pulled towards it. Why? Because it's a legal requirement. You know that you'll face the penalties if you don't pay the tax. Okay. So government, what they do is they at least promote in savings, right? If you're not investing, you should at least save for your future. Don't spend it outright. Why? Because obviously this will, being a welfare state, UK being a welfare state, this would basically turn out to be a very bad thing for them, because ultimately you will become a burden on the government. Okay. Now, the point is, there are four schemes that we will be discussing. Pensions, we've already discussed this in very detail, right? C's, enterprise investment scheme, and venture capital trust. All right. So C's is your seed enterprise investment scheme. Seed. You probably would have heard this term a lot within the last, you can say, 10 years, right? Seed money, seed round, right? So yes, the startups, they raise this round or they raise this money in a, you've probably heard about pre-seed as well, right? Pre-seed is before actually starting a business, before actually getting a substantial amount of before actually substantiating your idea. That is what pre-seed is, right? In a way. So the point is that there are various stages, and yes, this is one of the earliest stages of a business. Okay, seed enterprise investment scheme. So if a company raises money through the scheme, right, the people who are investing, the investors I'm talking about, we are studying for investors. All right. So the investors, number one, should not be a current employee of the company, but can be a director, right? Can be one of the directors, but not an employee, right? Subscribes for new ordinary shares for cash, because that means obviously they're issuing new shares within the scheme. So you need to subscribe for it, not buy it from any other person, right? Owns 30% or less within or through that scheme. Okay. If an investor basically has or meets these criterias, right, there will be three tax reliefs. Number one in income tax, number two CGT, number three IHT. IHT is your inheritance tax, which you obviously haven't studied right now, but the point is you guys have started CGT, right, in your TX class. So the point is that TX, and you basically have the idea what CGT is from your TX studies as well. Okay, so let's discuss the income tax relief. Income tax relief number one, reduction of income tax liability will be by lower off two things. Forget the higher off part. I'll just keep it very basic right now, right? Lower off income tax liability and 50% of investment. Lower off income tax liability and 50% of investment. Now, HMRC says, as per the tax rules, as per the law, you can carry back this relief as well. Carry back against previous year income tax liability. So if you're allowed to carry it back to the previous year income tax liability, you will have an option to choose between the current year tax liability, let's say it's 40,000, and last year tax liability, let's say it's 45,000, right? So let me just, so let's make this last year and let's make this current year. All right. So you can choose between the two, and obviously you will choose the higher off. Make sense? So let's say this is the higher off, current year, 45,000. Okay. You compare it with whatever amount you've invested, multiplied by 50%. So let's say you have invested 80,000. All right. What would be the 50%? Half of it would be 40,000, correct? Which one is lower off? Your investment amount. That means you will get a tax relief on this. How? This will reduce, this 40,000 will reduce your current year, because you chose current year, tax liability. And now your tax liability will only be 5,000 pounds. That's it. Your current year tax liability will only be 5,000 pounds. That's it. All right. Now there's a statement that I've written and it's marked in red. Since max investment allowed is 100,000 pounds, therefore max relief will be how much? 50,000. Okay. Don't forget that. Max investment allowed is 100,000, not more than that. Okay. So if you, let's say if you guys still have your brains working right now, you would directly link it to this. 30%, remember, owns 30% or less. So yes, it will be lower off 100,000 and 30% of the investment scheme, of the entire investment scheme. All right. And again, 30%, remember one thing, 30% is based on the number of shares, not on the value of investment. 30% is based on the number of shares. Okay. Essentially, it's based on the number of shares, basically. All right. Second relief, CGT relief, capital gains tax relief. What relief do you get in capital gains tax? If you sell one of your assets. So let's say you had investment in a company's shares, right? And you disposed of these shares for 125,000. All right. And you decide to invest these proceeds into a seize scheme, right? And let's say the gain on this is let's say 100,000. So the cost would be 25,000, right? The gain is 100,000. You decide to invest 125 in the C scheme, right? The point is lower off will be exempt. Lower off will be exempt. So 50% of gain, that means 50% of gain on the previous asset, obviously, which turns out to 50,000, and 50% of investment. So 50% of investment, and I'm assuming that I'm investing entire 125,000, guys. Don't get confused. I am assuming, I repeat, I'm assuming that I'm investing the entire 125,000 pounds. Okay. Now, 50% would be what? 62,500, right? Which one is lower off? 50,000. This is one thing. The second thing is, since max investment allowed is 100,000, therefore max CGT relief will be 50,000 pounds, not more than that. Guys, remember one thing, we're talking about the seed round. The company is very small, and seed is referred to what? You're a seed first, then you grow a small plant, you water it more, a medium-sized plant, then a large plant, and then a tree. Okay, so that's the natural cycle, right? What you have to understand is this is a seed. Okay, it's very small. It's very small side business. CGT is exempt if sale of SEIS shares are made after 3 years. So these shares that you've invested in, if sold after 3 years, the gain on these shares will be exempt. The gain on these shares, so for example, let's say I sell it for, it's highly unlikely that you get 500 against your 125 investment within just 3 years. It's a highly unlikely unless you create something like Facebook or Microsoft. You know, the next Facebook or Microsoft could get you these amount, or next Amazon can get you this amount of return. Not even Amazon, I believe, because Amazon started getting recognition after a certain period, approximately after 4 5 years, 5 6 years of its inception, right from its inception. Now, so the cost would be, this gain will be exempt. Okay, if sale is made after 3 years. Reinvestment relief will be available for the year in which income tax relief has been taken, right? So that means if you have claimed the income tax relief in the current year, you will get a CGT relief in the current year only. If you have claimed an income tax relief in the previous year, you will be able to claim the CGT relief. Income tax relief, if it's in the previous year, CGT relief will also be related to the previous year. All right. So the point is, don't just look at which income tax liability you have higher, current year or last year. You'll also have to consider which year you have capital gains in, right? From previous asset you will be selling to invest in Cs. All right. IH relief, BPR shall be available in gift of these shares as they are unquoted provided they have been owned for 2 years. Uh, just try to remember it, right? Just try to memorize it. We will be discussing it later in the IHT topic. Now, EIS, Enterprise Investment Scheme. If the funds are invested in the shares of an EIS company where the investor is not, now this is EIS, this is not Cs. All right. Where the investor is not an employee or director, subscribes new ordinary shares for cash, owns 30% or less. The only difference is what? In an SEIS company, you could have been a director, but in an EIS company, you cannot be a director. All right. Again, 3 tax reliefs, but this time the income tax relief is a bit lower because your risk profile is a bit lower. In enterprise investment scheme, you can say that this actually turns out to be somewhat between small and medium sized company, right? With relatively less, but as compared to a seed enterprise, better track record. Okay. Reduction of income tax liability by lower of higher of income tax liability current year last year. That means you can carry back your relief. 30% of investment this time. Since max investment allowed is how much? 1 million pounds. That is per investor, by the way, guys. Per investor per year. All right. Remember this. Even in the previous case, per investor per year. All right. Therefore, max relief will be 300,000 pounds. All right. Now, CGT is what? If an asset is disposed of and its proceeds are invested in EIS, then lower off will be not exempted but deferred. Remember this. This is another difference, right? So we have so far we have identified three differences: director, 30%, and deferral, right? And another fourth difference would be the entire gain or investment. So lower of gain or investment. There is no percentage, no 50%, anything like that. The entire gain can be deferred, or the amount of investment can be deferred against the gain of the basically the investment amount will be deferred, reducing the cost of your um, EIS shares, right? You guys know how to defer the cost, all right? So you guys already know how to defer it. Now the point is, how do you apply the BPR relief, which is very simple, is available on the EIS shares provided they were held for at least 2 years. All right. So this is the same. There's no difference, right? Extraction from SEIS or EIS. This is important. If SEIS or EIS shares are sold after 3 years, then no CGT. We know this, right? However, if loss arises, then the loss will be allowable. Okay. You're not being taxed on gain, but does not mean that the loss won't be allowable. Loss will be allowable. All right. If the shares are sold within 3 years, then what will happen? There's a withdrawal of the reliefs that you were given earlier, depending on whether you have sold the assets within 3 years, right? You already know it. Now, income tax relief will be withdrawn. That is, a relief will be repayable at lower of the original relief which you got. For example, uh, in our case, the case that we took, we got a relief of 40,000, right? So original relief or disposal proceeds multiplied by percentage of relief. So whatever disposal proceeds you have multiplied by the percentage of relief, which is 50% case of SEIS and 30% case of EIS, right? 100% income tax will be repayable if the transaction is not at arm's length. Remember this. 100% of it will become repayable if the transaction, that is when you're selling your SEIS or EIS shares, if it's not an arm's length, 100% of it will be repayable, right? Further, if the shares are sold on gain, then CGT will be charged, and if loss rises, then relief will be available. Yes, we know this, right? Capital loss on SEIS shares can only be relieved or can also be relieved against trading income, which we look at in the CGT chapter. Okay. Any CGT relief previously exempted will be withdrawn and will become chargeable at amount of income tax relief withdrawn multiplied by exempt gain divided by original income tax relief, right? So how will you get the amount of income tax relief withdrawn? From this formula. All right, from this formula. Get it? So how much of it is being withdrawn divided by how much was the original relief. If it's 100%, then 100% gain will be withdrawn. If not, then sum of it. All right. 100% exempt gain will be repayable if the transaction is not at arm's length. Any dividend received from SEIS or EIS shares will be taxed in normal manner. All right. Now, the point is that when we talk about EIS, it's deferral, right? The shares, the gain on the previous asset was deferred, right? So that becomes, that is obviously, that will automatically become chargeable if you're not, if you're selling it within 3 years, basically, right? If you're selling it after 3 years, then that gain can be, the original gain of that EIS shares will be exempted. All right. Conditional companies that can issue SEIS or EIS. This is all theoretical. You need to read this. Make sure you understand it. All right. What are VCT shares? Venture capital trust. You guys probably heard about it. Venture capital trusts are, it's like a fund, right? They have a lot of investors. They or let's say they raise money and they invest in businesses. They're expert of investments, basically. They have expertise in investments. All right. So the point is that venture capital trust is a bit less risky. In fact, it's relatively very less risky as compared to you know SEIS, directly investing in a company, or which basically is raising probably SEIS or EIS, right? So this is a pool of investments they have. They obviously invest according to the risk profile, right? So they don't put all eggs in one basket. What they do is they bifurcate. Okay. Since EIS and SEIS are high risk, already discussed it, the other 30% of VCT investment is parked in low risk investments. Investment in VCT shares is more preferable as compared to direct investment in EIS and SEIS. Why? Because they have highly competent investment individuals. Risk can be pooled through VCTs because of their diversified portfolio, and there's an easy exit for investors as shares of VCTs are quoted on the stock exchange. All right. Tax issues. VCTs can raise a maximum 5 million through the scheme. Maximum investment by investor is £200,000. No reinvestment relief, which is the CG relief, is available in VCT case. VCT holding period is 5 years. Dividend received from VCTs are exempt. VCT shares are exempt from CGT. No gain, no loss. You dispose it off, right? Whenever you want to. Does not matter. You get a very good price on it. You sell it off. No gain, no loss. All right. Income tax relief in the year of investment is at lower of income tax liability and 30% of disposal proceeds. If sold within 5 years, this income tax relief shall be withdrawn in the same manner as we discussed earlier. All right, this relief cannot be carried back nor forward. All right, so that is why I've written income tax liability, which means for the current year only. All right, you understand? All right, I guess there's an error in the notes. I'll send you guys the revised notes. I guess there are 2, 3 errors that I've identified in these notes. Okay, so I will send this to you. Now, there's a table that I have put out for you guys, right? I want you guys to read this table, try to understand what it says. There are various types of investments that I've put out, right? You guys know all of these, you've heard of all of these, you've studied all these, right? Make sure you understand the income tax implication, CDT implication, risk profile, liquidity, and income capital growth. The key is over here. Remember one thing, that your understanding of these types of investments will help you answer a question where the client asks you which one is more suitable for me. Not talking about general perspective, not talking about the general elements, but for a specific client, according to their risk profile, their age. Obviously, if a person is 60 years of age, you don't want to give him a heart attack by asking him to invest in the, let's say, a C's, right? Because that's very high risk. You cannot ask him to invest in a C's because he's already 60 years old. He's probably living on his pension, and you're asking him to put all his hard-earned eggs in, a very small basket that would, break. That is a very high probability of breaking, right? And then all the eggs would fall down, and then eggs will also fail, the break. All right. So the point is that ultimately everything is going to He's going to lose everything. So you don't want to do that. So accordingly, obviously, you recommend stuff to your client, but make sure that you understand this element. All right, that's it. We will do the questions of tax reducers along with some other topics, right? So I will start the questions on this after we've done with CGT. All right, guys, take care. Bye bye.